Welcome to this seminar. Let me first bring up the screen, and please do let me know if this is visible to everyone. Great. So what I'd like to do is to share some observations about current market conditions and tie that into some of our research findings relating to market concentration, relating to relative valuations, relating to the value factor, relating to diversification, and relating to forward-looking forecasts of long-term returns. It turns out that while it's nigh on impossible to predict with any accuracy what the market will do in the coming year, it's not all that difficult to divine what it's likely to do on a long-term basis over the coming 10 or 20 years. And that is very, very useful information. Firstly, looking at today's market, we're seeing a market in which a small group of winners has created tremendous market concentration. We like to describe the leaders as the FAN mags. That's the FANG stocks, Facebook, Amazon, Netflix, Google, and the winners from the first generation tech bubble of 1999 and 2000, namely Apple and Microsoft. These six companies at the end of the year were worth nearly $8 trillion. Now, 8 trillion is a big number. It's just a number. So let's put it into a context. There's two stock markets in the world that are worth more than that, China and the US. China, mostly because of their equivalent of the FANG stocks, the BAT stocks, Baidu, Alibaba, and Tencent, which comprise about 40% of the Chinese stock market in just the three companies. Take those out, and China is smaller than the FAN mags. The FAN mags are worth more than the entire publicly traded economy of Japan. Even more shocking, those six companies are worth more than any three economies in Europe. The publicly traded segments of the British, French, and German stock markets in aggregate are worth less than the FAN mags. Really quite remarkable. And it invites the question, is this a bubble? Well, people talk about bubbles all the time. And when they talk about bubbles, they rarely talk about it in any rigorous fashion with the term defined. And so it generally means frothy, unsustainable pricing, but identifiable best after the fact when you look back on 2000 and say that was a tech bubble, when you look back on 1990 and say that was a Japan bubble. I'm proud of the fact that in 2018, we came up with what I think is an actionable definition for the term bubble. It's got two parts to it. If we're using a valuation model, like a discounted cash flow model, we would have to use implausible, not impossible, but implausible assumptions about future growth in order to justify current prices. And as a check on that first assumption, the marginal buyers, none of the marginal buyers care about valuation models, whether it's GameStop or AMC or Tesla. How many of the buyers of these companies are buying a narrative, and how many are buying based on some sort of reasonably objective valuation model? They're all buying based on a narrative. We took a look at Tesla late last year, and we hypothesized, what if Tesla sees 50% growth every year for the next 10 years? Now that would make it 55 times as large in 2031 as it is in 2021, 55 times as large. Amazon, the stupendous winner of the last decade, is 11 times as large as it was 10 years ago. It's had growth of 26% a year. 26% a year is phenomenal growth. But that gets you to 11 times your size, not 55 times. So with 5 times the growth of Amazon in the last decade, what if Tesla also has the highest profit margin of any auto company that any auto company has earned in any single year in the last 10 years? The most profitable was a little over 10% after-tax profit in a very good year. And if we assume that and then discount it back to today with 55-fold growth, you get a valuation of $430. And that's using BAA bond yields as your discount rate, so a nice low discount rate. Pretty amazing. And so, yes, we can conclude that Tesla is a bubble, that GameStop is a bubble, that AMC is a bubble. That doesn't mean you short them. Bubbles can go longer and further than any skeptic could possibly imagine. The most extreme example I'm aware of is the Zimbabwe stock market during the summer of 2008, just as their hyperinflation was gaining traction. In the first 6 weeks of the summer, the Zimbabwe dollar lost purchasing power tenfold in 6 weeks. People fleeing ownership of the Zimbabwe dollar plowed money into the Zimbabwe stock market. And in Zim dollar terms, it soared 500-fold. In US dollar terms, it soared 50-fold. In 6 weeks, 50-fold. That's like GameStop magnified to an entire economy. And so let's suppose at the start of the summer, you said, there's hyperinflation self-evidently coming in this country. I don't want to own those stocks. In fact, I'm going to short them, but I'm going to be prudent. I'm only going to short 2% of my net worth. 6 weeks later, you would have been wiped out, bankrupt. Now, 8 weeks after that, the currency fell another 100-fold, and the Zimbabwe stock market essentially went to zero and stopped trading. So you would have been right, but bankrupt. Bubbles are dangerous. They can go much further than you can possibly imagine. There are also anti-bubbles. These are not so dangerous. Anti-bubbles are assets that where you'd have to make implausibly pessimistic assumptions in order to not earn a respectable risk premium. And as a check on that first assumption, the marginal seller pays no attention to valuation models. There are examples of these even today. State-owned enterprises in China and Russia. The marginal seller just doesn't want to own them because they're state-owned enterprises, and a corrupt kleptocratic state could easily decide, oh, we're not going to distribute any more dividends anymore on these companies. The thing about the anti-bubbles is they can't be on single stocks the way bubbles can. Any stock can go to zero, but they can be on categories of assets. State-owned enterprises have a yield of about 5%. If those governments want continued access to world capital, they'd better pay those dividends and allow those dividends to grow a little bit. Perhaps they grow just with inflation, not with the growth of the economy, just with inflation. Well, then you got a 5% real return, with bonds giving you a negative real return. So that's an example of an anti-bubble. Now, how do bubbles and anti-bubbles play out in terms of the impact on the market? They're most vivid at the top of the market. The top 10 top dogs, the most valuable companies in the world, almost always are big companies, prosperous companies, successful companies, fast-growing companies, trading at lofty valuations. There are plenty of big companies that don't make the top 10 list because they're not at lofty valuations. You almost always have to have both in order to make it to the top 10 list. So if we go back to 1980, the top 10 in the world were all US companies, every last one of them. It was the peak of the oil bubble. 5 of the 10 were energy stocks. So how did you do with those 10 stocks? 10 years later, 2 of the 10 were still on the list, IBM and Exxon. IBM fell from 1st to 8th place, Exxon from 3rd to 10th place. 10 out of the 10 largest market cap stocks in the world in 1980 underperformed the world market, 10 out of 10. And if you indexed, those were your 10 largest holdings. Interesting. So roll the clock forward to 1990. Well, that's the peak of the Japan bubble. 8 of the 10 largest companies in the world are Japanese stocks. Most of those are financial companies. Now, how did they fare? Over the next 10 years, 2 out of 10 were still on the list. NTT tumbled from 1st to 6th to 7th place. Exxon rose from 10th to 8th place. So Exxon did manage to beat the world market. The other 9 did not. And 8 out of the 10 fell clear off the list. All right, I'm starting to see a pattern here. 2 survivors, 8 that don't survive on the list, and 8 or 9 out of 10 underperforming the world market. What about the year 2000, peak of the tech bubble? 6 of the 10 largest companies in the world were tech or telecom. And how did these world-straddling giants fare over the next 10 years? Well, 3 were still on the list. Microsoft down from 1st to 3rd place, Walmart flat at 5th place, and ExxonMobil rising from 8th place to 2nd place. 2 of the 10 beat the market. One of those was not Microsoft. Interesting, in the year 2000, if you looked at the 10 largest tech stocks in the world by market capitalization, 0 out of 10 beat the market over the next 10 years. That's the nature of bubbles. 0 out of 10 beat the market over the next 10 years. Microsoft beat the market over the next 20 years, but only by 1% a year. So there's interesting patterns here. What we're seeing is that 3 out of 10 survived to 2010. Now roll the clock forward to 2021. How many survived over that 10-year span? 2. Apple soared from 10th to 1st place. Microsoft jumped from 3rd to 2nd place. The other 8 fell off the list, and the other 8, all 8 of them, underperformed the world market. Which brings us to today, where 8 of the 10 largest market cap companies in the world are tech stocks. Now, they aren't categorized as tech. Tesla's categorized as an automaker. Amazon's categorized as a retailer. But the competitive advantage of all of those companies is technology. And so what we're looking at is the biggest concentration ever in a single broad segment of the market, of the economy. That's interesting. How many of these will still be world-straddling giants 10 years from now? If history is any evidence, we should expect 2 or 3 of these to still be on the top 10 list in 10 years. We should expect 7 or 8 to fall off the list. I don't know which ones. We should expect 8 or 9 of the 10 to underperform the world market. Again, I don't know which one. So do we just underweight the top dogs? That's one strategy. Here we're looking at the performance of the MSCI World Index in the blue line over the last 40 years. And if you had $100 in the World Index in 1980, today, if you didn't spend any of the dividends and didn't have to pay any taxes along the way, you'd now have $4,000, 40 times your money. That's pretty cool. It's nearly a 10% annualized return. If you just chose the most beloved and popular company in the market, in the world market, and held that, reassessing once a year whether it was still the most beloved company and the most valuable company, you'd get the black line. You would have had 3.5 times your money. Not 40 times, 3.5 times. And that's before you pay any taxes, before you spend any dividends, and before you pay any asset management fees. Of course, owning the #1 stock in the world doesn't involve a lot of asset management fees. You could choose to own just the most valuable and beloved company in each country. That gets you the green line. You're looking at 14 times your money instead of 40. Or you could look at the top 10, the lists we were just looking at here, these top 10 constantly changing list, a pretty large amount of turnover, and you'd have the orange line, you wind up with 20 times your money. But bottom line is, owning the top dogs is not a long-term winning strategy. It can be a short-term winning strategy. Look what happened in the late 90s during the tech bubble. The #1 stock, the top dogs in each country, the top dogs, the 10 largest in the world, all rose faster, outperformed the MSCI World Index for about 4 years. Looking at 2013 to date, all of these lines, except the #1 per country, outperformed the MSCI World Index. The top 10 by world market cap, the #1, beat the world market. But when they fail badly. The drawdowns are daunting. Here's the drawdown as NTT fell from being worth more than the entire German stock market. One company worth more than the entire German stock market, as it fell out of favor. You wound up losing about 80% of your money. Cisco and Microsoft, when the tech bubble unraveled, traded hands as being the number one company, but they were down about 80%. So when it falters hard. Now, all of this leads into the question of value. This concentrated market is dominated by hyper-growth companies. And the narrative, like most narratives, is spot on. It's accurate, it's sound. The narrative is these companies are dominant in their industries. They're disruptors. They are creating product that people love. They are growing fast. There are no serious clouds on the horizon. They deserve a premium multiple. And they do. We have done work on a concept called clairvoyant value, in which you look at what actually happens to companies, and the growth stocks turn out to have been worth more than the value stocks, but by about half as much margin as the premium value that they sported at any given point in time. So the question here is, what about value? Value fell severely out of favor last year in the COVID crash, and they've been falling out of favor for a decade now. This graph shows the performance of the Fama-French value factor. Now, what is that? You take the stocks with the highest book to market, the lowest price to book value. Those companies are your value stocks. You take the stocks with the lowest book to market, the highest price to book value. Those are your growth stocks. Now, you track the performance of the value portfolio and the growth portfolio. You put 30% of the market in each category. So you're looking at the tails, but not the extreme tails. Top 30 versus bottom 30 in book to market. And once a year, you rebalance those portfolios so that growth stays growth and value stays value. Well, if your grandparents bought the Fama-French value portfolio back in '63, and their neighbor bought the Fama-French growth portfolio, today you would have inherited a portfolio 4 times as wealthy, as large as your next door neighbors. Well, that's pretty cool, except had you stopped in '07, you'd have been 9.5 times as wealthy. So this drawdown is horrific. We see drawdowns before: the Nifty 50, oil crisis, biotech bubble, the tech bubble, the biggest but not the longest drawdown ever. This one wound up being a drawdown of 40% for value relative to growth in the span of just a couple of years. This one grinds out over 13.5 years and is a total drawdown of 58%. So we were starting to see reports 2017, 18, 19, and 20 that value is dead, and here's why. Narratives about low interest rates helping growth stocks, narratives about value stocks being more dangerous, more vulnerable to bankruptcy than in the past, narratives about growth stocks being more special, growing faster than in the past. And of course, most narratives have a grain of truth. The question is, how much of that isn't already well known to the market and already priced into asset prices? Now, before we move on, I should note this 13.5-year drawdown is if you use price to book. Price to book is a terrible metric for defining value. It's terrible because in today's new economy, intangible assets are a very big part of the economy. We've all heard the cliche that our assets go up and down in the elevator every day. What if you use price earnings ratios to define value? Well, then your peak would have been 2013, right about here. What if you use price to book but adjust for intangibles? Then it would have been 2014, right about here. What if you use price to sales? 2017, right here. Or if you use RAFI weight versus cap weight, RAFI weight reweights companies to their economic footprint, not their market value. And so growth companies are reweighted down to their economic footprint, value companies up to theirs, using a blend of measures: price to book, price to sales, price to cash flow, and price to dividends. So using multiple measures, once again, your peak is 2017, not 2007. All right, it's still a 3.5-year drawdown that is daunting, nearly 50% versus 58 if you use price to book. In 2016, we wrote a paper entitled "How Can Smart Beta Go Horribly Wrong?" It was controversial, to say the least. We had competitors attack us with considerable vigor for the radical suggestion that strategies can become overpriced and underpriced, factors can become overpriced and underpriced. And if a strategy goes up in relative valuation relative to the market, its past returns will look great, and its future returns may be compromised if there's any mean reversion. That radical hypothesis, which everybody knows to be true for stocks or any other assets, was for some reason viewed as highly controversial. But in that paper, we had a variant of this graph, only through 2016 at the time, in which we looked at the performance of the FAMA French value factor, and we looked at its cheapness. How do you define cheapness for a factor? Well, it's the price to book value of the value portfolio versus the price to book value of the growth portfolio. And you can see here when the FAMA French factor peaked in relative performance, over on the right scale, the relative valuation was 0.24. What does that mean? It means the price to book for value was 1/4 that of growth. It sounds like a huge spread. It's not. The norm is 5-to-1. So value was actually trading rich in 2007 at a time when money was pouring into value strategies, at a time that set the stage for the quant crash in August of 2007, when value got savaged in the space of 3 particularly brutal days. Well, from that point until last summer, August, the relative valuation went from 0.24 to less than 0.08, from 1/4 the valuation of growth to 1/12 the valuation of growth. This point was 25% cheaper than value was at the peak of the tech bubble. Now, if you had this graph showing the relative performance in blue and the relative valuation in green, back at the peak of the tech bubble, you would have noticed a few things. Firstly, the lines are joined at the hip. They go up and down together. The short-term movement, the performance of value on a short-term basis, is utterly dominated by changes in relative valuation. In fact, almost every drawdown for value is accompanied by a drawdown in relative valuation that is bigger than the performance drawdown. Value underperforming by 40%, well, it got cheaper by 50% during the tech bubble. That meant book values for value were rising relative to the growth stocks. Well, that's interesting. We've seen a 58% drawdown here in performance, 68% here in relative valuation. Now, you can look at that and say, I can't stand the pain, get me out of here. And a lot of our clients did just that. Or you can look at this and say, I can't believe how cheap this is. If I can possibly persuade my clients to top up their value allocation, I really need to do that. And what do we find? We find that the rebound since then, wow, it's not been very large, has it? We've all noticed values beat growth by 20% in the last 8 months and has beat the market by over 10% in the last 8 months. That's tip of the iceberg in terms of any potential mean reversion, which invites the question, what happens with various levels of mean reversion? Firstly, if you get no change in valuation, if valuation stays right where it is, 99th percentile by historic standards, 0.088, roughly 11.5-to-1 relative valuation, a z-score of more than 4 standard deviations away from normal, you would expect, if there's no change in valuation, to pick up the standard risk premium for value. What is that standard risk premium? If you look at this graph, there's a wedge between these two lines. The performance is usually better and better and better relative to the valuation, even during drawdowns. Even during this meltdown of the last couple of years, the drawdown in relative price was bigger, meaning the spread widened, meaning the structural alpha remained healthy. This is one of the biggest surprises in our research. We published a paper in the first quarter issue of the Financial Analyst Journal entitled "Reports of Value's Death Have Been Greatly Exaggerated." And in that report, we point out that the value effect is alive and well. It's worked during this drawdown. That is to say, value has outperformed growth in terms of underlying fundamentals, but not in terms of performance. And the only reason it hasn't outperformed in performance is the drop in relative valuation. Well, this wedge works out to about 4.5% a year. That's the structural alpha. If we move, and by the way, structural alpha does have some variability, whether it's plus 1% or plus 7%, who knows, but it's highly likely to be positive. It hasn't gone negative even during this meltdown. If you move back to median valuation, which a lot of folks would say, how likely is that? That's a long way away. You'd make 7,000 basis points. But remember, here we moved back to median and blew through the median to a 4-to-1 ratio. Median was 5-to-1. We moved in 7 years all the way to median and then some. So it can happen. It may happen. But let's set easier targets. Let's suppose we move just to the 95th percentile, halfway up through the cheapest decile in history for value. What would we get? 3,000 basis points of outperformance. This is, I think, the most surprising number on this whole table. Now, why do we use value in any event? The standard answer is you use value to protect yourself against a bear market. That's actually a pretty weak reason to use value. Why is it weak? Value wins by an average of, let's say, 1,000 basis points, less than 1,000 if you're using price to book, more than 1,000 if you're using a composite measure of value. But it's a nice value add. The problem is it's concentrated. The average when a bubble bursts, like the Nifty 50 bursting or the tech bubble bursting, is that you add 3,000 or 4,000 basis points in a bear market. That's stupendous. When there's a shock to economic fundamentals, the COVID crash was a shock to fundamentals. The COVID crash started with arguably some bubbles, but the bubbles didn't burst. So we had a shock to fundamentals, and value sometimes loses and sometimes wins. The average result is neutral. So value doesn't necessarily help in bear markets unless a bubble is bursting. Where value shines is the first 2 years after a bear market, when value wins by about 2,500 basis points in 2 years. That's the average result, whether a bubble is bursting or there's a shock to fundamentals. Now, bear markets are usually about a year. First 2 years of the bull market takes you to about a 3-year span. Value beats the market by about 3,000 basis points during those 3 years. That's pretty good. That's a great reason to own value. If a bubble bursts, and maybe it is now bursting, the margin winds up being 6,000 to 8,000 basis points. Really huge. And if it's just a shock to fundamentals with no bubbly action that is bursting, 15% give or take, that's 5% a year. So value has its place. Now, where it starts to get more interesting is that the relative valuation of value here on the horizontal axis has a lot to do with how well value performs on the vertical axis. Here we're looking at the US in green, international markets in blue, emerging markets in burgundy, and we have a line of best fit, this dashed line, and we're comparing starting valuation for value relative to growth and subsequent 5-year return for value relative to growth. What do we find? Here we're using composite valuation, not price to book. So we're using a blend of metrics. And value sometimes strays up to almost half as expensive as growth. That's pretty expensive value. Sometimes as low as almost 10%, almost a 10-to-1 ratio. And where are we now? For international stocks, 20%. For US stocks, 15, nearly the cheapest ever. For emerging markets, 15, by a wide margin, the cheapest ever. And if you look at these patterns of return, when you're above 1/3 the price of growth, value wins about, 60% of the time by an average of maybe 1%. Not much to it there. If value wins by, let's say, a 4-to-1 ratio, now you're winning probably 75 to 80% of the time by an average of 3 or 4% per year. That gets pretty interesting. When it gets below 1/5 the price of growth, it almost never fails. Value almost never fails to win. And below 18%, it has never failed to win over the next 5 years. If past is indicative of future results, international is currently priced to give you about a 5% excess return for value relative to growth. For US and emerging markets, about 7%. Now, I mentioned RAFI earlier. RAFI is the fundamental index. It's the idea we pioneered back in 2004, and it's been live now for 17 years. So RAFI basically says, let's weight companies according to their economic footprint. ExxonMobil is 2% of the sales of all publicly traded companies, 2% of the profits, 3% of the book value, 4% of the dividends plus buybacks. We could argue endlessly about whether it's 2, 3, or 4% of the economy, or we could just average those. If you average those, you get 2.7%. Let's use that. That's a nice stable anchor so that as the market's opinion of ExxonMobil goes up and down, we're contra-trading against that. If Exxon is trading at a premium multiple, which it hasn't for a long time, we're going to say, thanks for those lovely gains. We understand the company's got a great outlook, but that's in the price. It has to beat those expectations in order to win from these prices. So I'm going to reweight it back down to its economic footprint. When it's trading cheap, as it is today, you're going to say, we understand the headwinds are severe. But the market knows that, and it's in the price. So the only way it underperforms is if the outlook is even worse than the market fears. So I'm going to reweight it up to its economic footprint. You create a stark value tilt. That value tilt is dynamic. If the market's paying a small premium for growth, you take on a small value tilt. It's paying a huge premium for growth, you take on a huge value tilt. And if we look at the relative valuation of RAFI relative to the cap-weighted market, it's ranged from 14% discount to 62% discount. And this is using all world, developed ex-US, emerging markets US, a whole array of countries and markets. Now, what do we find? If RAFI is trading at less than a 30% discount, the win rate is 63%. It still wins most of the time, but the average win is less than 1%. If the discount is 30 to 40%, it's 34% in international, developed ex-US. If it's 30 to 40%, the win rate is a shocking 88%, and that's over a 3-year span. So a relatively short 3-year span, 88% historic likelihood. It doesn't mean future likelihood, it just means that's the historic norm. And the average win in this level of discount is about 3 to 4% per annum over and above the cap-weighted market. When it gets to 40 to 50%, there's not a single time when RAFI failed to win over the next 3 years. US, all world, and emerging markets are all in this range. Emerging markets awfully close to 50% discount. In fact, it got above 50% discount last fall. At these discounts, US, all world, and emerging markets we would expect 7 to 9% excess returns over the cap-weighted market. 700 to 900 basis points per year for 3 years. Now, if that happens, it'll push the valuations up into the next category. But that does indeed, the historic evidence does indeed suggest that this is a really dangerous time to move away from value. Let's turn attention now to diversification. We not only hear that value is dead, but that diversification is dead. We hear that every time you get a stupendous bull market. We heard it in the late 90s. Every penny put into diversifying asset classes was painful. It inflicted an opportunity cost. You could have left your money in good old mama S&P, and you would have wound up richer. So diversification falls out of favor anytime you've got a sustained bull market. But let's go back over a pretty long span, go back 46 years. And let's look at 60-40, classic 60-40 S&P 500 and the aggregate for bonds. You'd wind up with 10.5% return. That's pretty good. 10.5% risk, that's fine. Sharp ratio of 0.6, that's pretty nice. Now, if you throw in other markets, mainstream stocks and bonds, including global bonds and international stocks and small cap, and then you throw in diversifiers. What do I mean by diversifiers? Diversifiers would be asset classes that are lightly correlated with mainstream stocks and bonds, that are not heavily held in most investors' portfolios, and that therefore provide diversification to both reduce risk and potentially boost returns for the patient long-term investor. Well, over this 46-year span, if you equally weighted 16 asset classes instead of concentrating on 60-40, you would have had slightly higher return, slightly lower risk, and a modestly higher Sharpe ratio. Okay, that looks great. That's nice to see. But here's where it's kind of interesting. Think about the span. 1975 was a low point for US stocks. The trough in 74 was the cheapest the market had been since the Great Depression. Now it's a lot more expensive. The valuation multiples have quadrupled. Bond yields were at then record highs, and they're now awfully close to record lows. So your S&P had a huge tailwind of rising valuation. Your bonds had a huge tailwind from falling yields, hence capital gains on top of rich starting yields, meaning 60-40 had a wonderful tailwind this 45 years. And even so, equal weighted helps. Isn't that interesting? So if we look at just the diversifiers, here we're looking at 6 asset classes: emerging market stocks and bonds, high yield bonds, TIPS, commodities, and REITs. 6 asset classes that are likely correlated with mainstream stocks and bonds, that are not heavily used by most investors, and that also provide a dose of inflation protection in the event that inflation reignites. Well, those asset classes seem to have a mind of their own. Late 70s, starting with the bursting of the Nifty 50 bubble, 60-40 had a rough sledding during that span. Diversifiers helped. They didn't produce great returns, but they helped. In the 1980s, 60-40 did great. Diversifiers did great also, but not as well. So diversification hurt you a little bit. 1990s, 60-40 was stupendous. And these are real returns. These aren't just nominal returns. Diversifiers did very well, but fell far enough short of 60-40 that a lot of folks were really regretting their allocations to diversifiers by the end of that decade. The 2000s, the lost decade, wasn't a lost decade for diversifiers. They did just as well as they did in the 90s. And then the 2010s, those were a lost decade for diversifiers. They started out fully priced, and they finished the decade reasonably cheap, especially when compared with mainstream stocks and bonds. So notice how different the return pattern is. And notice how the performance of 60/40 has a lot to do with what your starting Shiller PE ratio is and where that Shiller PE ratio moves during the course of the decade. When you see the Shiller PE ratio soar, 60/40 does great. It soars, it does great. It tumbles, 60/40 struggles. It soars, 60/40 does great. And so when your starting point is 4 times the multiple of 46 years ago, are we going to see a repeat of the 2010s, or are we more likely to see a repeat of the 2000s? I think this scenario is much more likely. In the interest of time, I'm going to skip this except to make the minor observation that if your starting point was equally weighted and somebody tried to talk you into moving out of diversifiers into 60/40, here would have been your relative performance trajectory by taking their advice. 60/40 underperforming severely, winning big for a couple of years in the tech bubble, underperforming severely, earning it almost back, and winding up being ahead on a cumulative basis for exactly 1 month of the last 45 years. Okay, I think the diversifiers are compelling. I'm going to close by talking about setting return expectations because that is central to long-term investment management. Start with the easiest, 10-year treasuries. What's the best prediction of 10-year returns for 10-year treasuries? It's basically the starting yield. The historic average yield over the last 200 years has been 5%. The historic average return has been just over 5%. Why does 5% lead to a little more than 5%? Because of roll down of the yield curve. As you move, the yield curve is upward sloping. So as you move, as the 10-year becomes a 9-year, you trade up to a higher yield and you cash in on that capital gain year by year. Okay, so that gives you a little bit of a boost. If your starting yield is 1%, as it was at the start of this year, your forward-looking return is actually lower than 1%. But bottom line is, it's basically a one-to-one relationship. What did the returns of the last 150 years look like? 2.2% real yield, 2.1% inflation, meaning the actual average yield was 4.3. You got 70 basis points from roll down on the yield curve and from yields coming down, creating capital gains. And that brought you to a 5% return. Okay, so far so good. What about today? Yield of under 2, meaning negative real yield. Inflation expectations, we're pegging that at 2.4. Why did we pick 2.4? The Fed is targeting 2 for PCE inflation. 2 on PCE is roughly equivalent to 2.4 on CPI. So we're assuming 2.4. Now, if historically the normal real yield is positive, like we see here, if we go from minus 0.6 to plus 1 or 2 as a positive real yield in the coming decade, that's going to lead to huge capital losses on top of anemic starting returns, costing us about 1% a year, bringing us to a 0.5% return expectation. The aggregate doesn't get hit nearly this hard, but treasuries do. So why bother? Let's just put it all in stocks. All right, stocks have their own version of yield as a predictor. The earnings yield, the reciprocal of the PE ratio. Here what we're doing is we're taking the Shiller PE ratio, price relative to 10-year smoothed averaged earnings. We're flipping that, taking the reciprocal, and it's the Shiller earnings yield, the 10-year average earnings divided by today's price. That's the green line. The subsequent 10-year return is the blue line. They're joined at the hip. So the skeptics who say, forget about the Shiller PE ratio, it's useless, have some explaining to do. This is a 73% correlation with 10-year subsequent returns. That's humongous. That explains over half of the variability in subsequent 10-year returns over a 100-year span. Now, what are we looking at here in terms of the record? The highest the earnings yield ever got was 18%. That was the summer of 1932, the depths of the Great Depression. We got almost that high. We got to 14.5% in the summer of 1982. Those set the stage for some very, very good returns for the S&P 500. Then we see low points, a low point in 1929, a low point in 2000, where the Shiller earnings yield was at record lows, about 2.3%. That's $2.30 earnings for every $100 you invest. That's terrible. We're now back down just under 3%, about 2.9%. Shiller PE ratio is at 34. At the bottom of the global financial crisis, the earnings yield was 8%. Historically, that would correspond to about a 12% annualized return for the S&P over the next 10 years. Instead, we got 16%. These predictions aren't bad. And where we are today would normally point to 1 or 2%. So again, let's look at the building blocks of return. The 150-year return for the S&P was 9%. Roger Ibbotson likes to say the historical return was 9%. Best expectation is 9%. When you say, yeah, but the yield is 3% lower than it used to be, he'll say, yeah, but that means that the market's expecting 3% faster growth. Give me a break. If you're getting 3% less yield, you ought to ratchet down your return expectations by 3. Fundamental growth. This was going from an emerging economy to a very mature, developed economy. Inflation, this looks about right. Valuation change. We've gone from Shiller PE ratio averaging about 12 back in the 1870s to 34 today. That works out to almost a 1% appreciation per annum, bringing us to our 9% return. So how do these building blocks look today? The dividend yield is now only 1.5%. Ouch. That's pretty lousy. It's been lower only in the year 2000. Real fundamental growth, we're expecting a little slower than the past, 1.6 in the past, 1.2 on a more mature economy. But who knows? There's probably 1% wiggle room in that either way. Inflation, again, we're assuming that the Fed achieves its 2% PCE inflation target. And that brings us to valuation change. Shiller PE is 34, historic norm is 18. Are we going to mean revert? If you go from 34 to 18, that's going to cost you 7% per year for the next 10 years in falling valuation multiples. But maybe it's a new normal. Maybe 34 is going to be sustained. We don't know. So we split the difference and we say, what if we go halfway? If we go halfway, we're still at 26 Shiller PE ratio in 10 years. We're still expensive, but that would mean 3% per year erosion in performance as the stock market gets modestly cheaper in the coming decade, bringing you to an expected return of just under 2. So where are we? Core bonds in the US, we're expecting 2. US large stocks, we're expecting 2. US 60-40, therefore, we're expecting 2. Global bonds, 2. Global 60-40, that's better. It's about 3.5. And the reason for that is EFA is cheap. US small, better than US large. EFA, much better than US equities or bonds. Emerging markets stocks, 8% is an expected return over the coming 10 years. And this doesn't even count the value component. We already saw evidence that emerging markets value, as evidenced as measured by RAFI, is likely to outperform emerging market stocks by 6 or 8% a year. That would take you to a 14% return. That's pretty stupendous. So just to recap, we're looking at 2% for 60-40. We're looking at about a 1 or 2% likelihood of earning a 5% return. Ouch. We're looking at global 60-40 giving you another percent, mostly due to the stocks. And we're looking at diversifiers. If you use TIPS, commodities, REITs, emerging market stocks, emerging markets bonds, high yield, equally weight those 6 diversifying markets, you get 4.4%. Take on a value tilt, you're probably up around 6%. Leave out the diversifying markets that are very expensive. TIPS have a negative yield. Why would you want to lock in a negative real return? Leave those out. Now you're up to perhaps 8%. So it's not hard to get this 4 up to 8, but you can't do it with a conventional 60-40 portfolio. And the final question I want to touch on is, these forecasts are all well and good. Are they useful? We took the methodology back 50 years. It's simply yield plus growth, growth in income, plus changes in valuation multiples on a presumption of halfway mean reversion to historic norms. That really simple approach has led to a wide range of forecasts. When we were expecting -2 to 0, we got 1.5. When we were expecting 0 to 2, we got 4. When we were expecting 4 to 6, we got 6. When we were expecting 8 to 10, we got 10. It's monotonic. Cool. So it works. Now, I've been called a perma bear. I'm not a bear on anything that's cheap, and there are things that are cheap today. But is this methodology systematically too bearish? I mean, these dots are pretty routinely above the forecast return box. But remember, we went back 50 years. This has been a 50-year span dominated by bull markets, by rising valuations and by falling yields. If you have rising valuation multiples and falling yields, you're going to take your expected return and you're going to err on the upside. If the coming decades do not involve further rises in valuation multiples and further tumbling of yields from today's level, that's hard to imagine, then the forecasts are likely to be about right. So bottom line is, these are very useful ways to forecast long-term returns. And look how tight the boxes are for the high returns. Plus or minus 1% is the first to fourth quartile range, plus or minus 2 on the lower return assumptions. So bottom line is, value didn't die, it just became cheaper. Diversification isn't dead. Diversifiers went from being fully priced a decade ago to being pretty cheap now. And we can increase our clients' odds of reaching their objectives if we use contrarian rebalancing and if we buy what's unloved and out of favor. Let's open it up to questions.
All right. Thanks, Rob. As always, you came well prepared with plenty of data and plenty of interesting charts for us. So thanks. Let's start off with the most popular question. Is there reason to conclude that the economy is now driven by bits and bytes rather than physical assets? So intangibles are cheaper and therefore provide a systematic advantage now to growth stocks. So kind of the reversal of the value premium that you.
Sure. That's one of the common narratives about why growth is the place to be and value is dead and gone and will never come back. The market's already pricing that scenario in. The 12-to-1 ratio between the valuation of growth stocks and the valuation of value stocks was the widest spread ever last August. So the market's already pricing that in. The question in my mind isn't whether that narrative is true. It is true, but whether that narrative is missed by the market, and if the market is behind the curve, meaning that the growth stocks will outperform from already lofty valuation levels. And that's the more interesting question. One thing that people overlook is that there are always disruptors. 1840s, it was the railroads. 1850s and 60s, it was the telegraph. Then along came the automobile and the television and the radio. RCA was the most expensive company in the market in 1929. And in the decades after that, never once regained the price level that they hit in 1929. Never. So are we going to see the same thing for some of the FANG stocks? Surely some of them are going to turn out to be stupendous winners, but they're priced to be stupendous winners. So they have to be stupendous winners just to be market performers. That's kind of interesting. They have to beat lofty expectations in order to outperform the market. And value stocks, post the COVID lockdowns, the narrative was there's going to be sweeping bankruptcies across the economy, and they're mostly going to be on the value side. Stay away. And that's what drove the valuations down to those record cheapness levels. Once you got visibility to a recovering economy post-COVID, to vaccines, meaning that the COVID nightmare would end, and to a point where the stimulus has prevented most of these companies from going bust, now you have a situation where people are saying, oh, well, if these stocks don't go bust, if they don't go to zero, what are they worth now? They're worth a lot more than the current price. Maybe I should buy some. So that's what's fueled the snapback in value. And as I said, you'd have to see value outperform growth by 3,000 basis points just to get you to the 95th percentile of cheapness. Midway up the cheapest decile ever.
Wow. Yeah, I guess it could happen, right?
That could easily happen.
Yeah, right, exactly. All right, I'm gonna move on to the next question. We're kind of running short on time. The recent rotation from growth to value corresponds to a rotation into cyclicals and a changing interest rate and inflation regime. Is there some relationship between these?
There's less of a relationship than is commonly believed. The narrative is low interest rates sustain higher valuation multiples for stocks, and low interest rates in particular sustain higher valuation rates for growth stocks because their growth is further out into the future and a low discount rate makes that more valuable. Okay, makes sense. Narratives always sound right because there's grains of truth in them. But if low rates help stocks to sustain higher valuations, why are stocks cheaper in Europe and Japan than in the US with interest rates near zero? Why were stocks in the 1950s 1/3 the valuation of today, despite treasury rates of 2%? So that narrative starts to ring hollow once you study history. As for growth relative to value, the low rates in the 1950s didn't fuel a surge in growth relative to value. It hasn't fueled a surge in growth relative to value in Europe remotely as substantial as in the US or China. And so these narratives usually have a grain of truth. The more important question is how much of this narrative is unknown to the market and not already reflected or over-reflected in share prices?
So I guess this one's kind of related. Can it be said that we're in a new regime? What's the impact of the continued liquidity provided by the Fed and the other central banks on your valuation analysis? I think that's good.
There was a wonderful paper by Charles Gove that came out just a week ago in which he pointed out that we've had 200 years of capitalist economies across the West in which capital was allocated based on someone saying, I have an idea, I want capital, venture capital or a loan, and I think I can make you money if you provide me capital. So the capital was provided to those who felt that they knew a path to create growth. And the providers of the capital were very interested in knowing, are you likely to pay the money back? Am I likely to make money investing with you? Now you have capital centrally allocated, not based on need, checks mailed to gainfully employed people, not based on ability to repay. The presumption is it's repaid by future taxpayers. So he describes this as an entirely new regime, a radical departure from essential elements of a successful capitalist system, and basically says when this has been tried on smaller scales, it's always ended badly. It's now being tried on a global scale. So grounds for some real worries. Is it a new regime? Well, sure. I mean, printing money has blown asset bubbles, for sure. Printing money will blow asset bubbles until people lose confidence in their currency. And so the real question is, are we going to push this far enough that we lose confidence in the currency? I hope not. I think we probably won't push it that far, but I don't know. I'm scared.
Well, related to that, does the historically unprecedented Fed interventions distort or impact your historical comparisons? Do they make them, I don't know, obsolete's the right word, but does it change how you, it has to change how you think about it at least a little bit?
It creates shocks, which increase the magnitude of potential market swings. So volatility will go through periods of time when you get a surge in volatility and then it settles back down. And during those surges in volatility, wild and crazy things can happen. Basically, anytime there's an actor in the economy making uneconomic choices that have nothing to do with how do I increase the value of this investment, this asset, it creates inefficiencies. Now, creating an inefficiency means you take something that's expensive and make it more expensive, or you take something that's cheap and make it more cheap. The patient investor will watch for these and contra-trade against them, but will contra-trade cautiously, averaging in. And if you do that when there's mean reversion, and who knows if that's 1 year or 5 years or 10 years, when there's mean reversion, you profit handsomely.
All right. Yeah, that totally makes sense to me. Okay, so I think we're already over a little bit. Can we ask you just one more question? Wanted to ask about the massive shift to private market investing. The fact that private market players are kind of capturing more of the value of companies and so on. Does that change what your multi-decade research has shown? Does it affect what you're doing at all? Yeah,
there have always been private markets. We've never had an environment where the regulatory regime was sufficiently unpleasant that going public was a bad idea. But, you know, if Research Affiliates ever goes public, I'm out of there. I don't want regulatory regimes to consume half of my workday. So going private is partly a matter of just common sense in business. To gain liquidity, to transform privately owned equity into liquid capital, going public will always be there, but it's certainly less popular than it used to be. We have less than half as many businesses as we had 25 years ago in the US, publicly traded businesses. We've gone from 7,500 to 3,400. Wow, that's daunting. So does it change the dynamic? Yes, but probably not radically enough. I mean, if you've got a successful business, you don't want to screw it up by going public, unless you're the founder and you want to cash in. And so there will always be going public. The fastest growing businesses will typically be privately owned. The publicly owned businesses will typically be slower growing, but that's why earnings and dividends for public companies tend to grow half as fast as GDP. If you go back over the last century, GDP growth was 3%, and growth in earnings and dividends on publicly traded companies was 1.25% to 1.5% above inflation. You still got real growth, but real growth in the economy consists of growth in existing enterprises plus creation of new enterprises. And that latter engine is big. Half of the US stock market capitalization is companies that didn't exist 30 years ago. Half.
Big turnover, for sure. I think we're going to stop there. So thanks, Rob, for joining us today, along with everybody who attended the event. At the end of the event, you'll see a notice to complete a survey about today's event. Your feedback helps the Society when planning future events, and it's greatly appreciated. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. Thanks again, Rob. It's always good to see you.
Thank you all to everyone who joined us. I hope you enjoyed it. I hope you found it useful. All the best. Take care.